Lots of news impacting the markets these days, from the ongoing U.S. government shutdown to geopolitical developments, some of which have been more positive, some of which continue to be challenging either to the markets or individual economies, to the employment market appearing to soften here in the U.S., though that's a little bit old data at this point because we're not getting the data that we're used to due to that aforementioned U.S. government shutdown. That said, the bond market appears to not really be paying attention to that and or is focused on something else. So what you'll see here in a second on your screen in blue is the MOVE Index. So this is bond market volatility, a measure of that, similar to what the VIX is for stocks. This is the fixed income equivalent. So you see in blue the MOVE Index, you see in white the 10-year Treasury, and we'll talk about that relationship in just a minute. But if we focus first on the MOVE Index in blue, we see a pretty precipitous decline over the last few months. So not quite a cliff, but not far off from it. In fact, we're back to levels we haven't seen since 2021. So if the market isn't focused on the things I've mentioned before, what is it looking at? And in our estimation, it's really the alignment between the FOMC and market expectations, because they're really closer than they've been in a long time, at least over the balance of 2025. We'll leave 2026 to another discussion. But at this point, they're closely aligned in terms of what the market wants or expects and what the Fed, at least at this point, is talking about that it plans to do for the balance of the year. So with that, we've seen that reaction. We overlay then again the white line, which is the 10-year Treasury, and you see that those two tend to move together, not perfectly, but often when one is headed up, the other goes that direction as well, and the same thing on the downside. So it really leaves us with the question, is this comfort or is this complacency? And there's a few things we've seen recently that lead us to maybe think it's more complacency. So if you look over the past few days, you've seen equity market volatility go up considerably with some of the same news I mentioned previously. You've seen the next typical step, which is in the credit markets. You've seen that show up as well. So investment grade credit spreads, high yield credit spreads, both gapping out the last few days of last week. And what you see on your screen is as of the end of September. So this is 10 years worth of monthly data. If we were to show you, the month of October, you would see, a continued decline in that bond market volatility measure, but then a pretty big spike over the last few days. In fact, we currently sit slightly higher than we ended September. So how do we interpret this and what do we see going forward? And we really see two paths. And it comes down to the reason for the rise in volatility. So the first path would be FOMC oriented, if you will. So if the Fed comes out and says, we're not going to lower rates as much as the market expects or as quickly as the market expects, we would expect to see that volatility head back up, and we would expect to see interest rates follow it up as well. So vol up, interest rates up. If the other reason is really what we're seeing today, which is equity volatility concerns there, maybe it's economic oriented or whatever the cause, higher equity volatility, higher spreads as a result, and spread volatility, again, we're going to see that MOVE Index move up, but we're likely to see treasuries fall. And that's exactly what we've seen this month. So we'll come back to those reasons. Currently it seems like the second one's taking hold. We'll see if we get any sort of volatility generated by the FOMC over the next few months. If not, we'll come back and share thoughts as we see other causes for what's going on right now. But thanks for taking your time with us today.